pension fund accounting is drifting into scandal by making these unreasonable investment assumptions. It's evidently just part of the human condition that people extrapolate the recent past. And so since returns from common stocks have been high for quite a long period, they extrapolate that they will continue to be very high into the future. And that creates a lot of reported earnings in terms of pension benefits that aren't available in cash and are likely not to be available at all. And this is not a good idea. And it's interesting how few corporate managements have just responded like Sam Goldwyn, include me out. You'd think more people would just say, this is a scummy way to keep the books and I will not participate. But instead, everybody just drifts along with the tide, assisted by all these wonderful consultants.
Yeah, I don't know of any case in the United States right now, and I'm sure there are some, but except for the pension funds that we take over, I don't know of any case where people are reducing their assumed investment return. Now, you'd think if interest rates drifted down several percentage points that might affect what you would think would be earned with money. It certainly is to bondholders or to us with float or something of the sort. But most major corporations, I believe, are using an investment return assumption of 9% or higher. And that's with long-term governments below 6%, and maybe high-grade corporates at 7%. They don't know how to get it in the bond market. They don't know how to get it in the mortgage market. I don't think they know how to get it in the stock market. But it would cause their earnings to go down if they change their investment assumption. And like I say, I don't know of a major company that's thinking about it, and I don't know of a major actuarial consultant that's suggesting it to the managements. They'd rather not think about it.
The way they're doing things would be like living right on an earthquake fault that was building up stress every year and projecting that the longer it's been without an earthquake, the less likely an earthquake is to occur. That is a dumb way to write earthquake insurance. And the current practice is a dumb way to do pension fund planning and accounting. Dumb and improper.
If you talk to a management or board of directors about that, you get absolutely no place.
Their eyes would glaze over before the hostility came.
I think stocks are a perfectly decent way to make 6 or 7% a year over the next 15 or 20 years. But I think anybody that expects to make 15% per year or expects their broker or investment advisor to make that kind of money is living in a dream world. And it's particularly interesting to me that back when the prospects for stocks were far better, I even wrote something about this in the late 70s, pension funds were using investment rate assumptions that were often in the 6% or thereabout range. And now when the prospects are way poor, most pension funds are using, building into their calculations, returns of 9% or better on investments. I don't know how they're going to get 9% or better on investments, but I also know that if they change the investment assumption down, it will change the charge to earnings substantially, and they don't want to do that. So they continue to use investment assumptions, which I think are quite unrealistic, and with companies with a big pension component in their financial situation and therefore in their income statement, that can be quite significant. It'll be interesting to me to see whether in the next couple of years, where pension funds are experiencing significant shortfalls from their assumptions, how quickly they change the assumptions. And the consulting firms are not pushing them to do that at all. It's very interesting. The consulting firms are telling them what they want to hear, which is hardly news to any of us, but it's what's taking place. Second question about inventory write-offs. That gets into the category entirely of big bath charges, which are the tendencies of management when some bad news is coming along to try and put all the bad news that's happened into a single quarter or a single year, and even to put the bad news that they are worried about happening in the future into that year. And it leads to real deception in accounting. The SEC has tried to get quite tough on that, but my experience has been that managements that want to do it usually can find some ways to do it. And managements frequently are more conscious of what numbers they want to report than they are of what has actually transpired in a given quarter or a given year.
The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures. They show up in opportunity costs. In other words, we have opportunities. We almost do it. In retrospect, we can tell that we were very much mistaken not to do it. In terms of the shareholders, those are the ones in our history that have really cost the most. And very few managements do much thinking or talking about opportunity costs. But Warren, we have blown
billions and billions and billions. I might as well say it.
Right, right. And we keep doing it.
Some might say we're getting better at it.
I don't like mentioning the specific companies because we may in due course want to buy, do so at our price. But practically everywhere in life and in corporate life too, what really costs in comparison with what easily might have been are the blown opportunities. I mean, it's an awesome amount of money. When I was somewhat younger, I was offered 300 shares of Belridge Oil. An idiot could have told there was no possibility of losing money and a large possibility of making money. I bought it. The guy called me back 3 days later and offered me 1,500 more shares. But this time I had to sell something to buy the damn Belridge Oil. That mistake, if you traced it through, has cost me $200 million. And it was all because I had to go to a slight inconvenience and sell something. Berkshire does that kind of thing too. We never get over it.
Yeah. I might add that when we speak of errors of omission, of which we've had plenty, and some very big ones, we don't mean not buying some stock where a friend runs it or we know the name and it went from 1 to 100. That doesn't mean anything. We only regard errors as being things that are within our circle of competence. So if somebody knows how to make money in cocoa beans or they know how to make money in a software company or anything, and we miss that, that is not an error as far as we're concerned. What's an error is when it's something we understand and we stand there and stare at it and we don't do anything. Or worse yet, what really gets me is when we do something very small with it. We do an eyedropper's worth of it when we could do it very big. Charlie refers to that elegantly when I do that sort of thing as when I'm sucking my thumb. And they're really, I mean, we have been thumb suckers at times with businesses that we understood well. And it may have been because we started buying and the price moved up a little and we waited around hoping we would get more at the price we originally started. There can be a lot of things. But those are huge mistakes. Conventional accounting, of course, does not pick those up at all, but they're in our scorebook.